Something crazy just happened in the US housing market. Something that breaks every real estate always goes up story you've ever been fed. For the first time in years, rents across America aren't just leveling off, they're falling. And not because the system suddenly grew a conscience or because housing affordability magically improved. No. Rents are falling because the entire rental market engine hit a hard limit. People see the headline rent prices down and immediately breathe a sign of relief. But when you live inside this affordability crisis, when the cost of living is devouring your paycheck before it hits your account, you know better. A slight drop in rent while groceries, insurance, taxes, utilities, and every other expense climbs, that's not a victory. It's a symptom. And it tells us something much bigger is breaking beneath the surface. Because when you peel back the layers, this wasn't an accident. It wasn't a market correction. This was the housing system confessing it pushed families way too far. Because behind every small rent reduction lies the real story. Soaring vacancies, an oversupply of multifamily units financed back when money was cheap, and a generation of young adults so squeezed by inflation and stagnate wages that they're living at home in numbers we haven't seen in decades. Now, household formation, the heartbeat of rental demand, has quietly collapsed. And when there aren't enough new renters, it doesn't matter how shiny the apartment buildings are. Empty is empty. The median US apartment rent falling in November sounds mild on paper. It's like a 1% drop here, a 5% drop from the peak there. But in a high inflation economy where the cost of everything else has exploded, a 5% nominal decline in rent is far more significant in real terms. So in fact, when you adjust it against the broader inflation curve, it's closer to more like 10% affordability correction. And that's not the rental market cooling. That's the rental market choking. And landlords know this. A record 7.2% vacancy rate in multifamily housing, the highest in modern history, means rental owners are discovering a painful truth. You can list a 2022 fantasy prices all you want, but the market, it's going to ignore you. That's why the REITs tied to rental income, they're starting to slide. Rising insurance, skyrocketing property taxes, and operating costs that outpace tenant income are crushing margins. This isn't rent moderation, it's landlord stress, plain and simple. So when the 18 to 34 demographic, historically the strongest rental base, is now living at home in record numbers, that's not a cultural trend. That's economic survival. It's a generation doing the math and realizing the housing market is fundamentally misaligned with the labor market. Because if wages haven't kept up with inflation and inflation hasn't kept up with rent growth, well, where does that leave the average renter? I would guess it mean they would be trapped between commuting distance and the comfort of their childhood bedroom. Look at cities like Austin, Las Vegas, Boston, Miami, markets where rent growth once felt unstoppable. Today, they're dealing with the consequences of oversupply, reduced tourism, softening job markets, higher insurance premiums, and shrinking wage power. Housing market data from CoStar, Redfin, Zillow all point to the exact same truth. Demand didn't soften, it retreated. And it retreated because the affordability crisis is no longer just about high rents. It's about the entire cost of living ecosystem collapsing inward. Even property taxes, once a quiet irritation, have become a full-blown crisis in states like Texas and Florida. Insurance premiums are doubling, HOA fees are exploding, and maintenance costs are eating into margins. So homeownership versus renting is no longer a clean equation like it might have been in the past. Because when condo fees include insurance and full building maintenance, and homeowners are facing $20,000 a year in maintenance burden, that idea the idea that a house is cheaper becomes a myth unless the spread is huge. And this brings us to the psychology of the moment. Sellers still priced at 2022 highs aren't just being optimistic. They're misreading the entire market. In a normal cycle, you price a home based on comps from the last 6 months. Today, that data ends up being outdated in 6 weeks. NAR is now telling sellers to price based on last month's comps because the market is moving downward faster than historical models predicted. Now, homes that sit for more than 2 weeks without offers aren't waiting for the right buyer. They're overpriced for the market. A property listed too high today sits longer, costs more in taxes and insurance, and ultimately sells for less after multiple price cuts. That's the hidden math behind falling rents and falling prices. It's like a slow motion reset of inflated expectations. And here's the part that people don't generally realize. Once developers slow down, and they already have, this temporary oversupply of rental units evaporates fast. The same builders who flooded the market with multifamily units in 2022 or 2024 have pulled back sharply due to higher financing costs, tighter liquidity, and bond market pressures. That means 2025 and 2026 won't look like today's oversupply. They'll look like a shortage again. This is why understanding the housing cycle, not just the headlines, is so important. It's so essential. Because once you see the housing system as a machine rather than a market, everything suddenly starts to make a certain amount of sense. The Fed controls the pressure valve through interest rates. Banks control the flow of credit. Builders chase capital incentives. And renters and buyers absorb the consequences. When rents fall in an inflationary environment, it means the machine hit resistance. It means households can no longer carry the load the system demands. And when households tap out, the system, it has to adjust, either through price correction or through new mortgage engineering tricks designed to disguise the real cost of housing. Because make no mistake about all this stuff, guys, the machine is already adjusting. Builder incentives like 4% buy-down rates, 50-year mortgage proposals, teaser rate structures, and new lending products are emerging as the next phase of the affordability theater. Because when the rental market cracks, the mortgage market begins looking for new ways to keep buyers in the game. And that is exactly where this story leads. So what do you guys think? Do I have this all right? Do I have it all wrong? Please put it in the comment section below. And of course, I look forward to reading and replying to all of your guys' comments. And again, thank you guys so much for watching me here on The Baseline. Okay, cheers, everybody.